In an unexpected turn of events, the US Treasury Department dropped a bombshell last week, revealing that their special measures to cover federal government expenses had dwindled to a mere $88 billion by May 10th. This marked a significant decrease from the previous week's $110 billion. Once this dwindling reserve is completely depleted and the debt ceiling remains unlifted or unsuspended, the U.S. may find itself on the brink of a catastrophic default, a scenario that U.S. Treasury Secretary Janet Yellen has long anticipated. Yellen, in an interview on May 12th, further expounded on the imminent danger of a U.S. debt default. She cautioned, "If Congress doesn't act, it will truly damage our credit rating. We would have to default on certain obligations, whether it's U.S. Treasuries or payments to Social Security recipients." She went on to stress the unprecedented nature of such an event, stating, "It's something that's never been done before since 1789. We shouldn't even consider it going forward. So we haven't yet had discussions about how to prioritize in that event." When queried about the possibility of the U.S. Treasury Department's proposed plan to prioritize the payment of U.S. Treasury interest and principal, an idea floated by several parties, Yellen dismissed it outright. She recalled her time as the vice chair of the Federal Reserve in 2011 and affirmed that the plan had never been presented to the White House nor received approval. Yellen firmly rejected the notion of prioritizing debt repayment, believing it would amount to a de facto default. This leaves the U.S. Treasury Department with the difficult choice of either paying all principal and interest or defaulting on all U.S. bondholders. To exacerbate matters, the scheduled negotiation between the U.S. Congress and the White House regarding the debt ceiling, which was set for May 12th, was unexpectedly postponed until the following week. This delay has only heightened market concerns over future uncertainties and risks associated with U.S. Treasury bonds. The yield on the one-month U.S. Treasury note, set to expire in June, has surged over the past 2 weeks, a clear indication that an increasing number of global investors are keen to divest from these Treasury bills, fearing the U.S. Treasury Department's potential inability to meet payment deadlines before June 1st. For years, U.S. Treasury bonds had enjoyed a reputation as relatively risk-free assets, bolstered by constant assertions from the U.S. Treasury Department and the White House, who insisted that Congress unconditionally raise the debt ceiling based on this advantage. Implicitly, they conveyed the message that global buyers of U.S. Treasury bonds would bear the financial burden for an extended period. President Biden, for instance, warned after a fruitless May 9th meeting with House Speaker McCarthy that the world would be in dire straits if the U.S. defaulted. However, the U.S. debt ceiling impasse, which has persisted since January, appears to be an unbreakable deadlock, eroding the confidence of the U.S. Treasury Department and the White House in U.S. Treasury bonds and the U.S. dollar. The U.S. Debt Fear Index has reached an all-time high, and investors are growing increasingly anxious about the looming threat of a U.S. default. The one-year U.S. Credit Default Swap (CDS) trading price has soared to 176 basis points, surpassing the highest level seen since August 2011. A White House report has grimly projected that a debt default could inflict severe damage on the U.S. economy. In such a protracted default scenario, approximately 8 million people could lose their jobs, and the stock market could plummet by 45% for an entire quarter. Senior economist Richard Bernstein has underscored the damage being inflicted upon the U.S. by pointing to the credit default swap market. While the likelihood of an actual U.S. debt default remains relatively low, the cost of insurance for U.S. bonds over the next 12 months is about 50 times higher than that of Germany. Additionally, default insurance costs for 3, 5, and 10 years are roughly 3 times that of Germany. While Germany may not wield the same level of influence as the U.S.'s credit standing appears to have taken a massive hit. Years of reckless abuse of its reserve currency status, with the Treasury Department and the Federal Reserve constantly monetizing debt, have irreparably damaged the U.S.'s credit and incurred losses that cannot be compensated for. In a program aired on May 10th, former U.S. President Donald Trump joined the conversation surrounding the current U.S. debt crisis, urging Republicans to allow the U.S. to default on its debt if Democrats fail to agree to substantial spending cuts. However, Trump also expressed doubt that a default would occur, predicting that Democrats will absolutely cave in the end. While the U.S. debt crisis continues its relentless march, The country's banking sector finds itself ensnared in a crisis of its own, a crisis that has been unfolding since March of this year. The latest development involves Pacific Western Bank, teetering on the edge of bankruptcy, reporting a staggering 9.5% decrease in deposits just last week. The bank's stock price plummeted to an all-time low earlier this month, reigniting fears surrounding the U.S. banking crisis. This week has witnessed a sharp decline in the stocks of numerous small and medium-sized banks once again. Even J.P. Morgan Chase CEO Jamie Dimon, who had previously declared the U.S. banking crisis over, issued a warning on May 11th, insisting that preparations must be made for further escalation of the crisis. Dimon also expressed grave concerns about the potential debt crisis in the U.S., stressing that a default could have far-reaching and long-lasting repercussions. To navigate this treacherous terrain, the U.S. must exercise extreme caution to avoid triggering a full-blown financial panic. Some analysts speculate that if a U.S. debt default were to occur, the recent trend of bank failures, such as Silicon Valley Bank, Signature Bank, and First Republic Bank, coupled with the ongoing volatility in the U.S. banking sector, could be part of a strategic maneuver by Wall Street bankers to resist the Federal Reserve's interest rate hikes. There are even suggestions that these bankers may be pushing for a revival of the quantitative easing program. This intricate web of events underscores the inherent instabilities surrounding the U.S. dollar, U.S. government debt, and the overall creditworthiness of the U.S. economy. The global shift toward de-dollarization and divestment from U.S. government debt continues to gain momentum. Over 111 countries have embarked on various degrees of de-dollarization, while at least 26 of the top 30 holders of U.S. government debt have consistently sold off substantial portions of their holdings over the past year. These ongoing trends illustrate the ever-evolving landscape of the global economic and trade sphere, further accentuating the decline of the U.S. economy. On May 11th, U.S. Treasury Secretary Janet Yellen issued a stark warning, highlighting how a debt default could undermine America's leadership position in the global economy and jeopardize its national security. She called upon G7 allies to implement targeted controls on investment in China. It is worth noting that Yellen has repeatedly emphasized the importance of resuming economic dialogue with China since February of this year. The latest international capital flow report from the U.S. Treasury reveals a significant decrease in China's holdings of U.S. government debt, reaching their lowest levels since the 2008 financial crisis, totaling $848.8 billion. Over the past decade, China has offloaded nearly $467.9 billion in U.S. government debt, representing a divestment ratio of approximately 36%. In contrast, China has been actively increasing its gold reserves, acquiring an additional 128 tons consistently for the past 6 months, bringing its total gold reserve to around 2,076 tons. Financial analysis firm Zero Hedge speculates that China may accelerate its divestment from U.S. government debt on a larger scale, favoring gold instead. This looming prospect is certainly unfavorable for the heavily indebted U.S. economy, which continues to borrow from the world despite surpassing its debt ceiling. It also poses a challenge for U.S. Treasury Secretary Janet Yellen, whose position as a reliable issuer of U.S. government debt appears somewhat tenuous in light of these circumstances. Express your thoughts by leaving a comment in the section below. We appreciate you for sticking with us until the end of this video. Before you leave, please show your support by giving us a thumbs up and subscribing to our channel. Don't forget to hit the notification bell to stay updated with our latest videos. We look forward to seeing you again for more captivating content in the future.